Welcome to the deep dive. Today, we're getting into something really important, but maybe a bit overlooked, the notes to financial statements.
Absolutely. They're kind of like the key to understanding what's really going on behind the main numbers on a company's reports.
Exactly. Think of them as the decoder ring. Our mission here is to give you a quick, solid grasp of what's in these notes and, well, why they matter so much. We're basing this on U.S. GAAP principles.
Right. The main statements. They give you a picture, but the notes, they provide the context, the how, and maybe even a heads up about, potential issues down the road.
Okay, so let's unpack that first major piece, the summary of significant accounting policies. What's its main job?
Well, fundamentally, this is where the company tells you the rules they play by, financially speaking. It's the groundwork, showing how they account for everything. Smart readers check this first.
To understand their perspective, basically.
Yeah.
So, what absolutely has to be in this summary?
Okay, they definitely must state their measurement bases, like how they value assets, liabilities. Then, the specific accounting methods they use.
Such as.
Things like how they handle consolidation if they have subsidiaries, their depreciation methods for assets, amortization for intangibles, spreading out the cost.
Right.
Also, inventory pricing is key, FIFO or LIFO. They'll state their fiscal year, too, and any special ways they recognize revenue, especially for complex stuff like long-term contracts or leases.
Interesting. So, it's their accounting DNA in a way. What won't we find right here in this summary section?
Good question. You won't get the nitty-gritty dollar details for specific accounts, no exact cash balance figure here,
Okay.
and deep dives into changes in accounting principles or all the specifics about their debt maturities. This stuff comes later in the other notes. This first part is really about the big picture methods.
Got it. Which brings us neatly to the next bit, the remaining notes to the financial statements. What's their purpose?
This is basically everything else. All the other details that are relevant for making decisions but didn't quite fit in the main statements or that initial policy summary, it can be a real goldmine of info.
Okay, like what? Give us some examples.
Sure. You'll find, say, more detailed breakdowns of their inventory or their property, plant, and equipment.
PP&E. Yeah.
Right. Also, any changes in stockholders' equity issuing stock, changes to retained earnings, things like that. Disclosures about marketable securities, their value, gains, losses.
Mm.
You'll also see fair value estimates, details on contingencies like potential lawsuit losses, maybe even gains, information on their contractual obligations, pension plans, segment reporting if they're diversified,
Wow, okay.
and significant events happening after year-end, subsequent events, plus those detailed explanations of accounting principle changes we mentioned earlier.
That's quite a list. It really does paint a much fuller picture than just the balance sheet or income statement alone. Now, let's shift to another really vital area, the disclosure of risks and uncertainties. Why is this one so critical for us looking at the company?
Because this section is all about transparency regarding potential future bumps in the road, things that could seriously impact the company's financial health. It's about what could go wrong.
Makes sense. What kind of disclosures are we talking about here?
Well, first, they need to describe their basic operations. What are their main products or services? Where do they operate? How important are different parts of the business? Give context.
Okay.
Then there's usually a standard bit about using estimates. Management has to make estimates, and, well, actual results might differ. It's a reminder that accounting isn't always perfectly precise.
Right, that dose of realism. What else is important here?
They must disclose specific, significant estimates if it's reasonably possible that the estimate will change in the near term, and that change could be material financially.
Okay, example.
Think about potential inventory becoming obsolete, or machinery, how they value deferred tax assets, maybe loan loss allowances, capitalized software costs, potential lawsuit payouts, amounts for long-term debt or contracts. These are areas where judgment calls can have a big impact.
Investors probably watch this closely.
They should, yeah, especially if the same significant estimates pop up year after year.
And the last piece under risks, current vulnerability due to certain concentrations. What's the key takeaway there?
This flags risks from, well, putting too many eggs in one basket, lack of diversification. They have to disclose a concentration if three things are true.
Which are?
One, the concentration exists right now. Two, it makes the company vulnerable to a severe hit in the near future. And three, it's at least reasonably possible that hit will actually happen soon.
So it's a specific warning sign. What kind of concentrations are we talking about?
Could be relying heavily on one or two big customers or suppliers, or maybe most revenue comes from just one product line.
Or a single factory.
Exactly. or even being concentrated in one specific geographic market. These can definitely be red flags indicating potential instability if that one area gets disrupted.
Super helpful. This really breaks down notes that can seem pretty intimidating at first glance. So, quick recap. We covered the summary of significant accounting policies. That's the how they account for things.
Right.
Then the remaining notes, the what, but in much more detail.
All the specifics.
And finally, the disclosure of risks and uncertainties highlighting potential future challenges and vulnerabilities.
Precisely. And remember, these notes aren't just some boring compliance task. They're the narrative, the story that adds crucial meaning to those raw numbers.
Absolutely. So here's something to think about. Given all the detail required in these notes, what does that suggest about, well, the inherent complexities and judgments involved in telling a company's financial story? And what questions should that make you ask when you're reviewing financial statements next time? That's your deep dive challenge. Thanks for joining us.